Hello, I'm Brian Zen. I teach investment analysis at St. John's University. I manage money for private and institutional clients at a New York investment firm. I have earned an MBA in accounting and Ph.D. in finance. I've also passed the 3 levels of CFA exam. In this study session, we talk about debt valuation. When you, the entrepreneur with business talents, want to borrow money to grow your business, you come to me, the rich investment banker, to borrow some money. And we can discuss some terms and conditions and put them into what is called a bond indenture. And in there, I will say something that you should do, and those will be the affirmative covenants. I would say, okay, you must pay me a certain coupon, an interest rate, at the end of the borrowing, and let's say it's 10 years down the road, you'll have to pay back the principal back to me. You, of course, will have to pay taxes and maintain the property in the best condition. In that indenture, we will also have clauses that is called the negative covenants. The negative covenants essentially what I'm going to tell you what you should not do. Okay, for example, you cannot borrow more debt and put those debt senior to my debt and then use those debt to pay me back, to pay me some interests. That wouldn't be allowed. For example, I would say, okay, you cannot borrow more than 60% of your total asset. That would be also a negative covenant. In that bond indenture, we will also specify more things. In the bond indenture between you and me, we will specify the maturity. It is the period at which all the interests and the principal has been paid and the bond would mature and expire. We will specify the coupon interest rate, what is called the coupon rate. It is the periodic interest payment that is often stated as a percentage of the par value or the debt in the United States with a par of $1,000. Let's say if the interest that you are going to pay me is 10%, so essentially you are paying me $100 per year. If I ask those coupons to be paid semi-annually, you will be paying me $50 per half a year. The par value will be specified. It's the amount of the principal that will be repaid at maturity. And we know in the United States, the par value of each bond is usually $1,000. However, some of those bonds are quoted at 100. When it's quoted at 100, it means it's 100% of the par value. So if a bond is being quoted at 90, it means the bond is trading at 90% of par value, and if par value is 1,000, to buy a bond, you would have to pay $900. We can also have the indenture, the bond indenture between you and me, spell out if we have any calls and puts. Those are the options that's embedded within the bond. We can also specify the currency denomination. If you are an entrepreneur from a foreign country, let's say Germany, and you want to borrow in Europe, you want to do your borrowing in euro, we should specify the currency that you will be repaying me back. Of course, we can put other things. We can put different kind of affirmative clauses and negative clauses, what you should not do in that huge document called bond indenture. 2 terms that you should clearly distinguish in your mind. Bond indenture is different from the word debenture. Indenture is the debt agreement between you and me. Debenture is a debt without collateral. In our bond agreement, we can specify a varieties of different coupon rate structures. And let's take a look at those different coupon structures. First, we can specify whether the interests will be paid semi-annually or annually. Essentially, if you are paying the coupon interests once a year or twice a year. We can also specify if the coupon interests will be paid monthly or bi-monthly. The mortgage-backed securities in the United States usually have interests payments that's scheduled monthly. We can also have accrual bonds where in the beginning of the period you are not going to get any interest payments, and all those interests accrue into the bond principal, and then in the end you get one big check as repayment of the borrowing. We can have zero coupon bonds. You're not getting any coupon interests. At the end, you get your principal back. Of course, the par value, the principal, will be trading at a big discount to the par. We can have step-up notes where the coupon rate will increase over time. We can also have floating interest rate notes. Essentially, the interest rate will be reset, let's say once a quarter or every half a year, or according to whatever prevailing market rate that is. For example, LIBOR, London Interbank Offering Rate, one of the major floating interest rate instrument that's used in both Europe and United States. Usually here, you reset your interest rate according to the market every quarter. We can also have our coupon structured as deferred coupon. Essentially here, you delay the coupon payment for a stated number of years. If we have a coupon structure that with the floating rate, we can have a varieties of schemes to determine how do we determine the floating rate. For example, we can have something called an inverse floater. Essentially, I can say I'm going to lend to you at the coupon rate of 10% minus LIBOR. That would be an inverse floater. So if LIBOR rate go up a little bit, the interest rate you will be paying me will go lower. The inverse floater works like this. Let's say currently LIBOR is 5%. So 10% minus 5%, you are paying me 5% right now. 3 months later, LIBOR went from 5% to 6%. 10% minus 6% becomes 4%. So 3 months later, you will be paying me 4% instead of 5%. We can also have floating caps and floors. Caps is essentially if the LIBOR interest rate goes above the cap, let's say the cap is 10%. If LIBOR shoots to 12%, you will not pay me 12%. Your payment to me is capped at 10%. The floor, let's say if we have a floor of 3%, is the lowest that the interest rate that you pay me will go. For example, if LIBOR goes to 1%, but you are not going to pay me 1%, you still have to pay me 3%, the floor rate, the minimum rate that you will have to pay me. And also, the way that we set the interest, when do we reset the interest, and when do you pay me the coupon, will also have a varieties of ways. Typically, we reset the interest rate at beginning of the quarter. So at the beginning of the quarter, we take a look at the market LIBOR rate. We set the interest rate that you will be paying me. And then at the end of the quarter, you actually send the check over to me as your coupon payment.